Stop what you are doing right now, because what I am about to explain matters more than anything distracting you today.
Pause the noise, ignore notifications, and give me your full attention, because the market just crossed a line it cannot return from.
If you own silver in any form, physical, ETF, or futures, I need you calm, focused, and thinking clearly before reacting emotionally. Do not open your brokerage app yet, because confusion without context creates panic, and panic is exactly what institutions rely on. What I am about to share would have sounded impossible just 24 hours ago, yet today it is mathematical reality.
Yesterday, the market tried to stop silver by raising margin requirements, changing rules, and pressuring traders into forced selling.
Those moves were designed to scare retail participants, protect short positions, and manufacture a controlled collapse in price. I told you then it would fail, because fundamentals always overpower temporary rule changes and artificial pressure tactics. Before we go further, take a second to like this video and subscribe, because what follows will matter in coming weeks. Doing that helps this information reach others who are still blind to what is unfolding across global commodity markets. Today, the silver market did something I have never seen in my lifetime watching financial systems closely. The Shanghai Futures Exchange closed at $104 per ounce, while New York stalled far lower. That difference is not small, not normal, and not something a functioning global market can tolerate for long. The spread between East and West has exploded to $13 on the exact same metal.
In a healthy market, arbitrage erases gaps quickly because traders buy low, sell high, and force prices together.
That process depends on one simple thing: actual metal being available to move between markets without restriction.
Right now, that condition no longer exists, and that is the core truth you must understand.
Western vaults are empty, inventories are drained, and the silver backing paper claims has already been removed. Smart money saw this months ago and quietly took physical delivery while the system still functioned. Now the paper market is exposed because claims exist without the metal required to honor them. Yesterday, the spread was $8, already signaling stress few analysts wanted to acknowledge publicly. And today it is 13, and that acceleration tells us the system is losing control rapidly. This is not volatility, this is structural failure unfolding in real time. The price in Shanghai reflects physical demand, real buyers, and immediate settlement with metal, not promises. The New York price reflects paper contracts, leverage, and confidence that delivery will never be demanded. When those two diverge this far, one price is real and the other is fiction. Before we continue, remember to like and subscribe, because understanding this early is a massive advantage. Most people will only pay attention after headlines confirm what the numbers already prove today. The arbitrage is not expensive, not difficult, it is dead, because there is nothing left to move. Even if metal appears, export restrictions mean once it enters China, it cannot leave again. That destroys the bridge between markets and traps pricing into two separate realities. We now have a paper market in the West and a physical market in the East. Only one of those markets can survive when confidence finally breaks. In the next part, I will show you why banks are trapped, what happens next, and how this resolves. The most important question now is why banks cannot fix this spread and walk away with easy profits. In reality, banks face three walls that completely block this trade from ever happening. First, the metal simply is not there anymore inside Western vaulting systems. Registered inventories have fallen to levels that cannot support existing paper obligations.
Multiple claims exist on every ounce, meaning ownership is theoretical rather than physical. Second, even if banks locate metal, exporting it east creates a one-way trap. Once silver enters China, capital controls and licensing rules prevent smooth reversal of trades.
Banks would receive currency they cannot freely move, while losing control of the metal itself.
Third, and most critical, banks are already massively short silver across futures and derivatives.
Buying physical metal would push prices higher and immediately increase losses on their own positions. They are trapped by their own strategy, unable to buy without accelerating self-destruction. Take a moment here to like and subscribe, because this context matters more than daily headlines. Understanding bank incentives explains why this spread grows instead of shrinking as textbooks predict. This is why the gap widens instead of closes, signaling systemic stress rather than opportunity.
Markets are not mispricing silver accidentally. They are revealing structural insolvency in paper systems.
The illusion of one global silver price has officially collapsed under physical reality. Here you're for Epicurus. Now let us talk about what this means for the banks themselves going forward. For years, they suppressed silver prices using leverage, spoofing, and paper volume. Regulators fined them occasionally, but profits always exceeded penalties, reinforcing bad behavior. That model works only when physical delivery is rare and trust remains intact. Once physical demand overwhelms paper supply, leverage flips from weapon into liability.
Short positions face unlimited losses when prices rise without available supply.
Silver is not a stock that can theoretically fall to zero. It is a required industrial input with growing demand and limited mine output. When shortages appear, buyers pay whatever price necessary to keep operations running. Banks now face two catastrophic paths, neither offering a clean escape. Allowing force majeure would admit paper contracts are unreliable and destroy confidence permanently. Letting prices rise freely would impose losses large enough to threaten financial stability. Neither option preserves credibility, which is why intervention attempts keep escalating. Margin hikes, rule changes, and paper dumping are delay tactics, not solutions. Before we go further, make sure you are subscribed, because the next phase moves fast. When systems break, information delays cost more than almost any financial mistake. Now consider what is happening outside silver, because this is not isolated. Gold is making new highs, bonds are selling off, and hard assets outperform globally. This pattern reflects declining faith in debt-based currencies and financial promises. Silver simply reveals the problem first, because its market is smaller and more fragile. What breaks here eventually spreads across other leveraged commodity and currency markets. So what should someone realistically do with this information today? If you hold physical silver, your position improves as paper credibility eroding. Selling into manipulated prices risks trading scarce assets for weakening currency.
If you hold paper silver, you must assess counterparty risk honestly. Cash settlement at suppressed prices becomes likely during delivery stress events. Cash settlement at suppressed prices becomes likely during delivery stress events. Paper profits mean little if conversion into metal becomes impossible.
If you hold nothing yet, availability matters more than perfect timing now.
Shortages create price gaps that never reopen once trust collapses. Waiting for pullbacks assumes a functioning system that may no longer exist.
Let me be clear, this is not financial advice, just rational observation.
Explaining incentives, constraints, and outcomes based on observable data. Everyone must decide based on risk tolerance and personal circumstances. The $13 spread is not noise. It is a warning flare. It tells you the paper system lost its anchor to physical supply. Once that anchor snaps, repricing happens violently, not gradually. This is why I say we are entering the endgame phase. If solution does not come quietly, it comes through shock events and forced resets. Those prepared early react calmly, while others scramble under pressure. I will end with this simple thought for you to consider. Markets lie slowly, but tell the truth suddenly when stress peaks. Right now, silver is telling the truth very loudly.